Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about the new Dogs of the Dow Target Income ETF, Palantir's earnings, and qualified charitable distributions. But before we begin, as a reminder, this is a financial education presentation. It should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. There's a new ETF out called DOGG. Can you tell us what it does and how it works?
Hey, good morning, Allison. Good morning, everybody. And I came across this idea from the First Trust folks not too long ago, and it combines kind of the best of both worlds. That's why I want to present it to you today. I'm also looking at picking up some shares and some, accounts that aren't in models, and we're going to be redoing our models here in the next week and a half or so, time dependent, to kind of rewicker things a little bit. But the two strategies this combines is one is a dogs of the Dow strategy. So as you know, there's 30 stocks in the Dow, right? The Dow Jones Industrial Average, 30 stocks, diversified. It used to be you could just own the Dow and be good. You could still do that if you want. Some big names, right? There's heavy qualifications to get into the Dow component. So the dogs of the Dow treats, since all 30 of them are great companies, it says invest in the bottom 5 or 10, i.e. the dogs, the ones that are out of favor. And if you always invest in those are the ones that are returning to favor. Instead, kind of that buy low, sell high mentality, versus if you go with the high flyers, you're buying the best performing ones. And then inevitably they're going to switch positions as, markets go through time, that sort of thing. So that's the dogs of the Dow strategy. So this ETF takes the bottom 10, not necessarily the bottom 10, but generally it works out to be the bottom 10, and does a target income strategy. Now, when I say target income, that does have a financial engineering component to it, which I don't like, but in this case, I've vetted it. I like it. It's fine. I know exactly what they're doing. And generally with financial engineering, it's if they can explain it to me in 3 minutes, and I understand it, I can go, okay, then I'm on board. If it takes 30 minutes and I still don't know what you're talking about, it seems like a magic trick, then it's like, okay, I'm out, right? Because I don't want to get scammed. I don't want to buy into something I don't fully understand. So in this case, I know exactly what they're doing. And that's using covered call options to hit a target income. So what does that mean? They start with the baseline dividends of the highest 10 dividend paying stocks in the Dow. So the highest yield, actually, to be technically accurate. And so if the top 10, which are generally the bottom 10 as far as performance, that's that dogs of the Dow piece, say the average yield on those is 4.5%. Well, they have a target of 8% for this fund. So therefore, they use options, a covered call strategy, which is, in my opinion, the safest option out there, where you're selling it to generate income, and you're capping your upside. But they're also, leaving plenty of room for that, 10 to 12% move up, but you're not the 15 to 25 to 30% move up that we would love to see in the market, but we probably just aren't seeing that anytime soon. So it uses that to generate the rest of the income. So if the 10 stocks are yielding 4.5%, they'll use options to generate the other 3.5%. If it's yielding 4, then they'll use options to generate the other 4%. So all of that adds up to 8%. So what does that mean to you? If you own this ETF, and it's a little bit expensive, it's got 0.75 expense ratio, because this takes a lot of work on their part. But after the expense ratio, it's kicking out basically, that 8%, divide that by 12, that's 0.75% a month, and it pays out monthly. So this would be right for folks that are looking to generate cash, whether they're in retirement or they just like cash coming into their account so they can turn around and reinvest it. I get that. That's a great strategy. So that's why I like it. It does have the upside component of big, strong names, strong balance sheets, only deals with Dow stocks, combined with the aggressive use of options during volatile times, which is, now, for us to be able to generate the extra income there. So you have that coming in the door. So expect to see that. If you have any questions about that particular index fund, it's only a couple weeks old, came out April 26th. So I was excited to see it finally open up. It's pretty small right now, and have big hopes for it.
Next, Palantir crushed earnings yesterday and jumped 20%. Is it time to get back into this once favorite stock?
Okay, Palantir was all the craze right back in, I don't know, 2, 3 years ago when they came out, and charismatic, if not quirky CEO and Alex Karp with some crazy hair. He's since toned that down. We'll see if there's a picture here. It's not about the CEO's hair, but it does kind of portray a personality. And so he's got, I won't say evil genius, but certainly the quirky genius look to him. And he comes up with a company that is here to data mine basically and take all these data points and make it into decisionable intelligence for decision makers. I worked in the Middle East for a year in an ops center. This is what we did 24/7. We took information in, we sorted through it, we packaged it into what I would call decisionable intelligence, and then twice a day we would present that to the leadership team for decisions. That's on top of all the stuff that's flowing in over the real time. But the longer term strategy stuff was a big, strong formula in place. Well, their software helps people do that / does it for them. They're big into government contracts. There's everything to like, except for one thing. The CEO took this huge pay package a couple of years ago and basically, this is my opinion, drained the company so hard that it really never recovered. That's when I left the stock. When I saw that is 100% a sign of greed. When you talk about investing, you kind of talk about the horse and the jockey, the horse being the business, the jockey being the leadership, either the CEO or more accurately, the leadership team, right, including the board. Really an assessment of, okay, great company. Do they have the proper leadership in place? Apple's probably the best example. You have a premier company with a premier leader in charge of it, right? This is where you have a premier company and the leader, to me, is personally questionable. That's keeping me out of the name. So ultimately that will be a no, hard no for me, even though I love their company. This was a $35 stock. Somewhere in here was the pay package, and that's when people left in droves. It's been bouncing around as low as 6 and change. Could you scalp it? Yeah, you could. You could go. It's probably coming back to some extent, but I just don't trust the leadership team, so they're not going to get my dollars. So at your own risk, if you will, if you're interested in moving back into Palantir.
Last, qualified charitable contributions are a great way to donate to charity without having to pay taxes on your required minimum distribution. How do these work?
Okay, great question. This is so everybody's, but you just paid your big tax bill, right? And you're angry about it, right? That happens every year. So how do you reduce taxes? One of the strategies out there is if you are giving to charity, you can use a charitable distribution to do so. You wouldn't want to just give to charity because of this, right? But if you are giving, if you have charitable giving in your overall financial situation, this is how to do it most tax efficiently. The issue is it's got a quirky rule in there, which got me yesterday, and because it didn't get fixed by Secure Act 1.0 or 2.0. But to cover the basic strategy, out of an IRA, so money that has not been taxed, you are required at some point to take a required minimum distribution. At that point, you can take the required minimum distribution. If you take it into your own bank account or your joint taxable account or check in the mail kind of thing, you're going to pay tax on that money that you put out. And it's taxed as income, right? Because it's never been taxed before. However, if you take that chunk and donate it to charity, then you are not taxed on it. So you still have the effect of the government needs you to draw down your big IRA that you built for 40, 50 years. However, if you give it to charity, it's non-taxable. So you really get a nice tax break there. The issue is the age associated with this is not any of the ages that make sense. One age that would make sense would be 59 and a half. As soon as you can withdraw from your IRA, you'd be able to give it to charity and have it be tax-free. That's not the case. You have to wait until 70 and a half, right? The RMD age was 72, just moved to 73, and it's going to 75. So why not tie it to one of those ages? It's a complete administrative oversight, and it happened twice. It was missed in Secure Act 1.0. They said, don't worry, we'll fix it in Secure Act 2.0. Newsflash, we already have Secure Act 2.0 and it's not fixed, right? So we still have kind of the legacy date. For years we operated on, you had to start RMDs at 70 and a half. Well, it's still there, right? For QCDs. It should be fixed at some legislation at some point in time. But right now, that's the age, 70 and a half or after. So you're not at R&D age anymore, and you're not at the beginning of the window. You're at some random date right in the middle. So you kind of have to keep that straight. The good news is you can either remember that yourself, your advisor can help you, or Schwab or whoever, whatever custodian you're processing these through will also keep you straight here in case you mess that up. But bottom line, you identify it. You fill out a form that says, I want this charity, say Salvation Army, just to pick one. Salvation Army, $500. You send that to, in my case, Schwab, because that's who we use for our custodian. They send you a check made out to the Salvation Army for $500, and you send it to Salvation Army. And when they cash it, that's when it's actually removed from your account. So officially, they put a placeholder in there ahead of time, so you know that you have it in process. And once that happens, that satisfies your required minimum distribution, and it meets your donation for charity. And then once you fill out your taxes, if you're still doing your own, it simply asks you, it's just like, how much did you withdraw out of your IRA? I took out 5,000. And then it says, were any of these QCDs? And if you say all of it, it says cool. You're not taxed on any of the 5,000. If you do a piece of it, then obviously it reduces for that piece. So kind of a complex tactic. So I wouldn't go it alone without doing some decent amount of research to make sure you get it right. But overall, great strategy to be able to donate to charity, feel good about yourself, use your money for a positive thing, and not give it to the government.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.